welcome to this webinar. Thanks to those in the Caribbean and Latin America for early starts, and those in Asia like myself for staying up late. I'll just give it another 20 or 30 seconds to allow you to get to your desks and get the headphones set up. Close what you were doing. So my name is Will McFarland. I'm pleased to be your host tonight. Although this is an evening for us. I'm based in Vietnam, and with a young family, this is almost my usual bedtime. I work for the SNV Netherlands Development Institute. We're one of the partners in the ICR Facility. I'm a global technical expert on climate and business. And although Vietnam is not a focal country for this project and this work, which is focused on ACP countries, I work globally, and I'm grateful to have been brought into the project by the ICR Facility team for this particular project on private sector and climate adaptation. My role today will be to chair and introduce the speakers and host the fascinating group of panelists that we've lined up for you today. This online event is being organized by the ICR Facility. This is a program co-funded by the European Union, the Organization of African, Caribbean and Pacific States, OACPS, under the 11th European Development Fund, together with the German Federal Ministry for Economic Cooperation and Development, BMZ, and the British Council. And we are 4 implementing agencies: GIZ, British Council, Expertise France, and SNV. Before I continue, I want to mention something now that will be covered again at the end, in case for whatever reason some of you must leave early. We really encourage eligible entities, organizations, individuals to apply for the technical assistance that the ICR Facility can provide. We have a one-to-one support facility and also deeper technical assistance funds available on these issues of private sector development, business environment reform, investment climate reform, and in particular, hopefully, on climate adaptation in the private sector. So please see the slides and details in your follow-up emails. You can follow the LinkedIn page, Investment Climate Reform Facility. And before we continue, please note that this event is being recorded. All of you, except the panelists, are automatically muted, so shouldn't pose any problems. But just to let you know, this is being recorded. Okay, so our agenda for today. We'll have some introductory remarks from Miguel Campo Lopez, who's policy officer at the DG DevCo, Private Sector and Trade Unit in the EU Commission. We will have a kind of presentation of work that we've been doing in this area to kind of set us up for great conversation from Richard McNally. And then we've got a great panel lined up for you. Dr. Muhammed Syed, climate specialist in the Climate Finance Unit at the Development Bank of South Africa. Ladé Araba, the Managing Director for Africa at Convergence, the Global Network for Blended Finance. Tigere Muzenda, who's the Regional Investment Officer for Africa for the Dutch Fund for Climate and Development, which is a 160 million euro private sector investment fund on climate adaptation established by the Dutch government. Tiras Mabratu, who's Director for Resource Mobilization and Project Monitoring and Evaluation at the Ministry of Forests and Climate Change in Ethiopia. And Charlene Watson, a Research Associate at the Overseas Development Institute, a leading global affairs think tank focused on justice, inequality and sustainable development. So that's the agenda. I'll be the facilitator, linking between everyone. So first, I'd like to welcome. We have apologies from Escipión, but I'd like to welcome for introductory remarks Miguel. As I said, Miguel is policy officer from DG DevCo and the Private Sector and Trade Unit of the EU Commission. Miguel, please.
Yes, thank you very much, William, and good afternoon to everyone. And indeed, Mr. Escipión de Oliveira, the Assistant Secretary General of the OACPS, Organization for Africa, Caribbean, Pacific States, sends his apologies and and he couldn't join us in the opening remarks. But just to say that this webinar takes place, as William was explaining, in the context of the ICR Facility, which is a joint initiative from the African, Caribbean, and Pacific Secretariat and the European Commission, and it reflects on our joint views and our joint priorities in how to work together with the ACP countries to support them in their challenges, and even more now under the context of the economic and health crisis that we've been facing for the last year. In particular, as we will see today, and I will try to be short to let you time to listen to the real experts, but one of the issues that is very much at the center of our agenda in the European Commission, it's how to support our partner countries in their effort to fight the challenges related to climate change. And as such, we launched the Green Deal initiative under the new Commission at the end of 2019. This Green Deal reflects how much emphasis we will put, and we are already putting, on trying to support countries not only adapt but also mitigate the impacts of climate change from all perspectives. And as with any other issue that we're trying to work within the Agenda 2030, we see the need to very much involve in this exercise the private sector. We all have acknowledged already that without contributions from the private sector, together with the efforts of the public sector, we won't reach the sustainable development goals that we all agree to work towards. So we need to bring them on board. We need to make them key players in this exercise by bringing their expertise, but also by bringing investments and by participating actively in the efforts that the countries are doing. It's not enough that the governments are pushing for the agenda, are trying to bring investments, are trying to do policy and regulatory reforms. We need also the private sector. And it is in this context that within the ICR, we have been working with the different implementers, SMV, GIZ, Expertise France, and British Council, in trying to discuss with experts on how we can do this and how we can mobilize. But as you will see in some of the papers that we have already in the ICR web page, this is only the beginning. ICR can offer support, and we strongly encourage all the participants today to listen to the experts, but also to reflect how we can continue supporting you afterwards through the ICR facility or other instruments that we have in the Commission, and some of them also with our partners of the OACPS, to support you and to help you work on the policy, on the regulatory, working with the financial sector to mobilize investments and make sure that we try to promote as much as possible all those elements that will help us navigate through the effects of the climate change. So I leave it here. Again, I leave you with the experts. They will bring the very interesting ideas, and hopefully we can continue discussing bilaterally as we provide you support through the ICR facility or the instruments in the near future. So hope you have a great webinar, and thank you very much.
Thank you very much, Miguel. Yes, and this is actually the second webinar kind of around this theme of private sector engagement in adaptation. We held another one in late November 2020, and it, as you said, Miguel, it kick-started some really interesting bilateral conversations with requests from governments to kind of understand and engage with the ICR facility to collaborate together. So really encourage everyone to get in touch with the facility after this event or during the event, yeah, let's kind of make this the start of working together. So a brief one slide here on the ICR Investment Climate Reform Facility. These are the the goal of the facility is to contribute to improve the investment climate in ACP countries through technical assistance at 3 levels. And these are the three boxes on the left-hand side: supporting enhancement of the business environment, and reforms to enhance that, supporting policies and reforms to make the business environment more socially and environmentally sustainable, and supporting public-private dialogue processes. There's a few different components of the program. One is a technical assistance, like request-based technical assistance facility. There's also an output of the project working on development finance institutions, working with kind of sub-regional and national development finance institutions. And actually, there's a great paper. Maybe we can put a link up during this event. A great paper actually on the role of national development finance institutions in climate change as well. That's recently been launched by our colleagues in the facility at GIZ. Okay, before I continue and introduce Richard, I just want to say to everyone, in your kind of dialogue box, there's the opportunity to ask us questions. If you click on chat, you can see here some links from us to you with kind of the LinkedIn link and the website link. And if you've got questions for the panelists or for Richard, the presenter, or want to kind of talk with each other, then please put them up there, and we'll kind of certainly get round to questions from the audience at the end, and depending on kind of how specific or not they are, I can feed them into the flow of the conversation as we go. So please do use that and engage with us throughout the event. Okay, great. So now I'd like to begin and introduce Richard. We're actually in the same room. We're lucky to be here in Vietnam where that's possible. Richard is the former global head of climate and business at SMV and is now freelance but remains a long-term consultant with SMV. He also works with a number of other international institutions such as the Green Climate Fund and United Nations Environment Programme, providing technical and strategic input focused on private sector and financing of climate action. Whilst at SMV, Richard led the design of a large program operating in East Africa focused on developing climate resilient agribusinesses, as well as the Dutch Fund for Climate and Development, which we will hear more about later from our panelist Tigere. And between these projects, as well as many others in his career, he's got some great experience on these issues of private sector and adaptation. So, welcome Richard, over to you.
Thank you very much. Thank you very much, Will, for those words. And it's a pleasure to be here today as part of this webinar and as part of the Climate Smart Investment series organized by the ICR, the Investment Climate Reform Facility. As has been outlined before, this series is really to focus around how to stimulate private sector investment into climate change adaptation into ACP countries. And as part of this work, we've been working on a number of different papers to answer some of the key questions around this issue. If I can just go to the next slide. Yep. So what is the ICR facility? Oh, let's go back one. Okay, thanks. So the ICR Facility Climate Smart Investment Knowledge Series, just to give a bit of outline on this knowledge series before I go into the topic of today. As I mentioned, this series is focusing on how to mobilize private investment to build resilience, particularly in ACP countries. We're working on 3 papers. Paper 1, which is authored by Will McFarland, is really setting the scene around identifying why we need to engage the private sector and why it's vital to deliver the climate adaptation in ACP countries. A number of these issues were raised earlier by Miguel. Paper 2, which is more of the focus around today's discussion, is looking at the role and solutions that international concessional finance can provide in order to stimulate private adaptation investment. Again, the focus is ACP countries. And then finally, we have a 3rd paper, which is authored by Charlene Watson, which is going to look at which illustrates the role of domestic finance and fiscal policy in directing and incentivizing private finance towards adaptation. So these 3 papers will be available and produced over the course of the next couple of months. So the topic of today. So today's presentation, I'm going to focus more around the paper 2, which highlights I'm going to highlight some of the key trends, some of the key issues, and provide some suggestions on how we can overcome these challenges to try to stimulate, this slide, to stimulate private sector investment into climate change adaptation. The points raised in this presentation, I hope, will be part of the discussion when we bring in the key experts from the panel later on. So what are some of the key trends? As part of the paper, we did an assessment of the key trends. And what we found is, one, despite wide variation in the geographic and economic context of ACP countries, there's very much similarity between the priorities across these countries. If we look at the adaptation priorities of the ACP countries, we see that agriculture, we see that water are the top priorities for these countries. We see 2/3 of the ACP countries cover agriculture and water, and also other sectors such as disaster risk mitigation, forestry, and coastal zone management are also key. So across the countries, there's quite a lot of similarity in terms of the priorities for adaptation. Okay, next slide. Oh, slide before. So another key trend that we identified in the paper is there's an urgent need to scale up both public and private adaptation finance. What we see, and we've seen many reports, is there's a major shortfall in investment into climate change adaptation. If we look at the data available from the Climate Policy Institute, if we look at the graphic on the right-hand side, we see that roughly 30 billion a year on average is going towards climate change adaptation. The recent report from UNEP, the Adaptation Gap Report, highlighted that hundreds of billions of dollars are now needed for adaptation. So the amount going to adaptation is far below the number needed. Looking at the data as well from the Climate Policy Institute, it also highlights that most of the funds for adaptation are coming from public sector, primarily from DFIs, development finance institutes, but also from larger multilateral development banks. But what it also shows is there's very little, again highlighted before, very little private sector finance flowing for climate change adaptation. And when we look at the ACP countries, that number becomes even lower. So at the moment, the flows are very, very small. Again, and it's been mentioned before, if we're going to reach the target in terms of the adaptation finance needed, we have to find ways to stimulate the private sector to come into and provide investment into adaptation. A third trend which we see, and this is particularly relevant to the ACP countries, well, first of all, the businesses, financial institutions, and investors are all increasingly interested or trying to play more of a role in providing climate solutions. We can see this, for example, from the Task Force on Climate-Related Financial Disclosures. We've seen also that there's a growing number of impact investment funds which are related to adaptation. However, as we see from this graphic, the investment climate in ACP countries is typically very weak. The graphic, what it shows is the ease of doing business in 2019. And if we look at the blue lines, we see these are the ACP countries, then these are the least ease to do business in terms of countries. What this shows, it's harder to attract investment, let alone climate investment into these countries. So these are three key trends which we're seeing. So the question then became, and what became the focus of our paper is, how can we try to stimulate more investment going into climate adaptation into the ACP countries? So we looked at some of the key bottlenecks, some of the key barriers, and ways that we can overcome those barriers to stimulate more finance for adaptation. We particularly identified three key issues, and I hope we can discuss these issues in more detail as part of the panel discussion. Firstly, when we look at the national adaptation plans in countries, more and more countries are putting these plans together, but what we see is they're not being translated into clear financing or clear investment opportunities, and not providing a clear signal to the private sector of where the finance or the investment is needed. A second issue that we found is that investors regularly struggle to find a deep and broad pipeline of potentially investable projects which support climate change adaptation. And then thirdly, a key issue we found is that the current financial instruments may not always be suitable for encouraging investment into very high-risk countries and high-risk issues such as climate change adaptation in ACP countries. So what we did is we looked at these three issues and tried to come and put forward some potential solutions moving forward of how we could overcome these issues. So in terms of responses, and this is what this is very much covered more in the paper. One, we feel there's a need to translate the national adaptation plans into a framework or into clearer investment plans and potentially investable projects. If we look at the UNEP Adaptation Gap Report 2021, again, looking at the graphic on the right-hand side, we see that more and more countries are prioritizing their national adaptation plans. But if we look at number 3 and 4, we see that very few are actually putting a clear finance and a clear investment figure to those plans. We have some growing good examples of more countries doing this, and those lessons need to be shared across countries. But what is clear is there's a major, what we see a gap in terms of translating these adaptation plans into documents or into plans which can be attractive to investors. There is a possibility then to try to translate these into priority investment areas, try to look at possible pipeline which could attract investment. What are some of the barriers to attracting investment? What are some of the financial instruments which could link to that? And then how can we link that to different sources of finance? So we feel that more could be done around this area. It's also important that, and it's very clear that private sector finance cannot fund everything. A lot of the issues in climate adaptation, for example, coastal protection, provide public goods and need public investment and support. So it has to be very clear what is for private sector, what is for public sector, and how we can mobilize that private sector finance, which links back to the national adaptation plans and policies of that country. A second response in terms of the three big issues that we identified is that we feel that in order to stimulate or mobilize more investment for climate adaptation in ACP countries, more support needs to focus around the project preparation and life cycle financing. What we find in the ACP countries is there's a lack of mass of private sector players and prospects suffering from undeveloped financial and capital markets. We also know that there's many small, medium enterprises which dominate many of the sectors in ACP countries, and also they dominate the sectors which are most vulnerable to climate change. So agriculture, water, forestry are predominantly have the influence of small, medium enterprises, which often are unattractive to private investment, the so-called, or sometimes referred to, the missing middle. What we see is there's a need for more targeted and longer term support to build this pipeline of projects, and that can be linked back to the first issue we highlighted in terms of the national adaptation plan. This could be in different forms, for example, design funding, business development support services, project preparation facilities, all of which would help to build the potential pipeline of prospects, adaptation prospects in ACP countries. We also feel a need to link investors to this pipeline early on. And as Will mentioned, I currently work part-time for the Dutch Fund for Climate and Development. And this has a very innovative way of what's called the origination facility, which helps to develop, originate pipeline. But at the same time, it has the investors, in this case, FMO and climate fund managers, as part of the process to help also ensure there is the perspective of the investor early on, and they can take that up if the potential prospect meets certain criteria, and then they can themselves, if it meets certain criteria, invest into that prospect and take it all the way until it becomes cash flow positive. So these we see as two key issues: one, project preparation, and the second one on the life cycle financing. The third issue that we highlighted in terms of a challenge, the potential solution we think, or one solution, is there's a need for tailoring the right financial instruments and innovative blended facilities in order to be able to deal with the high risk of investing into climate change adaptation. We need to catalyze private finance through pooling of public and private finance into structured blended finance vehicles. We see here on the graphic the example of the European Fund for Sustainable Development, which has a guarantee and a blending facility. What we also find is that the current financial instruments, for example, senior debt, is not always suitable for investment into these riskier environments around climate change adaptation projects, which may be smaller prospects, riskier, working in riskier environments, highly vulnerable areas. So the actual types of financial instruments needed may be different. There's a need for financial instruments such as equity, risk sharing facilities, and as mentioned in the previous slide, grant funding. Grant funding in particular around the project preparation and the structuring of the potential business or investable cases. We have some great examples of these types of structured pooled vehicles, such as Climate Fund Managers, Climate Investor 1, also the Climate Investor 2, the UNSCDF LDC investment platform, which has innovative ways to try to overcome these risks and pool public and private finance together. Particularly important and a key point is that these different financing instruments also need to make sure that the climate funds are going to the most vulnerable groups, the ones sometimes which can be hardest to reach. As flows of adaptation finance are set to increase, we move towards COP26. The expectation is the $100 billion a year will have to increase. The European Fund for Sustainable Development is developing its new facility, the EFSD+, which will considerably scale up the amount of funding available for climate change adaptation. It's critical that these funds are reaching the most vulnerable groups and are reaching the most important and vulnerable climate adaptation projects. So those are just some insights from the paper that we're currently working on, and I hope that this will stimulate some discussion amongst the panelists, and I hope and I look forward to comments and thoughts and ideas and corrections on this. Thank you very much.
Thank you, Richard. Okay, super. Now we're into the panel session. So if I can ask the panelists to stick their videos on so we can see them, maybe keep yourselves muted until I ask you something. And a reminder to everyone else, please join in the conversation through the chat box, type in a comment, maybe depending on how time goes. We can even bring you in live. Okay, so first, I'm going to turn to Ladé. Ladé is an expert on blended finance and has considerable experience in structuring investments in Africa. She's previously served as technical advisor to the former Minister of Finance of Nigeria. Other roles, Ladé has been a technical advisor to the Nigeria Infrastructure Advisory Facility, to the Executive Secretary of the United Nations Economic Commission for Africa, UNECA. Ladé was formerly a senior investment officer at the African Development Bank and worked on enterprise development for the FAO. So yeah, really interested to hear your opinions and thoughts on this, Ladé. Richard's presentation mentioned the importance of project preparation facilities and life cycle financing to build a pipeline for adaptation projects. So I wanted to ask you to share your experiences and suggestions on how countries can build pipelines of projects which are attractive to investors.
Thank you so much, Will, and thank you to the ICR Facility for inviting Convergence. It's a pleasure to be with you this afternoon or morning and evening, wherever you're dialing in from. Before I respond to the question directly, I just wanted to give a quick introduction to Convergence. We are the global network for blended finance, as you mentioned, and we focus on generating proprietary data, market intelligence, as well as deal flow with the ultimate objective of catalyzing private investment at scale towards SDG-related projects in developing countries. So coming to your question specifically, I want to take a step back and note that more capital historically has targeted climate mitigation projects, which are often easier to commercialize due to the clear and visible revenue lines that are associated with these types of projects. But on the other hand, we've seen a lot of grants and early stage concessional capital for project design and preparation go towards adaptation projects. And I believe that's one of the points that was stated in the opening presentation. Now, I want to underscore that blended finance actually happens, it could be at a point in time, which I think is what we often think about in projects, but it's also across the entire life cycle of projects. And when you find sectors that are more difficult to commercialize or that are nascent or being projects that are being implemented in difficult jurisdictions, what you'll find is blending over the life cycle as well as a point in time is often the most viable means to create a bankable project that is then able to attract private investment as it matures. So we think that concessional capital really does need to play a very important role in the early stages, and that limited public and philanthropic resources should be leveraged strategically so that they can absorb the early stage risks that are involved in developing projects, and especially because they do have high capital requirements during that phase. That's typically not where you'll find a lot of appetite from private investors. So having that concessional capital come in through grants or even as technical assistance is quite critical when you're thinking about project development. So these facilities do need to be funded by governments, donors, the wider development partner group, and also foundations that are really interested in supporting climate adaptation projects. The project sponsor or developer also needs to be quite patient and recognize that it might take a longer lead time to get to bankability, so they need to think through some very innovative structures that they can apply as they are developing the projects. We've also seen pilot transactions that are time sensitive and costly, but ultimately can create that demonstration effect. So supporting those types of projects, but also thinking through the financing structures. And I think here, when you look at Convergence's design funding program, where we provide grants for early stage innovative blended finance vehicles, where we see potential for scale and replication, that's one way in which you can support early stage design work, but also create structures and models and vehicles that other people can replicate. We think that for blended finance to really be able to scale and to attract financing for adaptation, we need to develop standardized financing models that have been proven, they've been tested, they work, they can be replicated, so you're not constantly reinventing the wheel, and you're also simplifying these structures because investors ultimately want to understand what they're investing in. They need to feel comfortable, they need to recognize these structures, and they also need to see very clear revenue lines, as I alluded to previously. I can conclude with an example of a transaction that we have. If you visit our website, it's in our resource library, where we've talked about the Forest Resilience Bond, which was developed by Blue Forest Conservation, and it's effectively a multi-stakeholder model that uses upfront investment from private and philanthropic funders to fund forest restoration activities. Now, the beneficiaries, including public agencies, state utilities, effectively reimburse investors with principal and returns following project completion. By drawing on private investment capital, this model aims to increase the pace and scale of restoration activities. That's just one example of a structure that is innovative, but ultimately can be adapted and replicated, I think, in other regions as well. So I will stop here for now, Will.
Thanks so much, Ladé. I really liked what you said about having kind of financial models which can be replicated and you know, put into different countries and different subsectors, and I think that's yeah, really encourage everyone to look at the learning that Convergence has around different blended finance vehicles and transactions. And I think responding to that, I think the next two panelists, first Muhammed and then Tigere, are hopefully kind of working on and managing some kind of blended finance vehicles and structures that are interesting for everyone else to hear about. So next, let me bring into the conversation Muhammed. Dr. Muhammad's role at DBSA is to provide strategic advice to the bank regarding access to various climate financing mechanisms, such as the Green Climate Fund. His role includes conceptualization and development of proposals, responding to the priorities of DBSA, and he's establishing a climate finance facility. Muhammed has extensive experience in venture capital and has worked with numerous high growth SMEs across diverse sectors such as manufacturing, ICT, energy, biotechnology, and has a Ph.D. in biochemistry, which is maybe where all the innovation began. So, Muhammed, Richard's presentation highlighted the key role of development finance institutions to provide climate finance for adaptation. Yeah, it would be great for you to share your experience at DBSA on financing climate adaptation, and tell us, in your opinion, what needs to be done to support national development banks to provide more financing for adaptation.
Thank you so much, Will, and thank you, participants as well. So I think, firstly, DBSA, we are a developmental finance institution. We are a debt institution, so we focus on specific sectors around infrastructure finance. So we look at water, ICT, energy, transport, as well as secondary sectors around health and social housing. So our approach when it comes to climate finance is to focus on those sectors where we are mandated to work on. So we don't, for example, do agriculture. So if we look at, you know, those sectors I've just mentioned, you know, the biggest area where we feel we can make significant impact around adaptation is, of course, the water sector. Of course, historically, you know, the low-hanging fruit for us has always been climate mitigation. And if you look at all our proposals to the GCF to date, you know, it's geared more towards mitigation. Having said that, we do recognize the need, you know, to kind of increase financial flows to climate adaptation projects, and also try and crowd in private sector for both climate mitigation and adaptation. So the climate finance facility, which we established fairly recently with the support of the Green Climate Fund, it's very much a blended finance facility where we blend concessional finance from the Green Climate Fund through our accreditation with the GCF, and we blend that with you know, DBSA funding. And the idea is to provide credit enhancement to attract private sector capital. And so what we've done is we engage with commercial banks in South Africa, as well as other, you know, RAND-dominated countries in the region. So Lesotho, Namibia, Eswatini, just to get a sense of, you know, what sort of credit enhancement would they deem to be appropriate to de-risk some of these projects, whether it's on the mitigation or adaptation side. And the areas we were looking at on the adaptation side was purely the water sector. As I said, you know, we are not mandated to look at other sectors. So the CFF was conceptualized where we would focus predominantly on mitigation, 70%, and then 30% would focus on water projects, which would obviously, you know, have significant adaptation potential. And the type of credit enhancement that was seen to be appropriate for commercial banks to come in and support some of these projects was a combination of subordinated debt, first loss, as well as tenor extension. I think Ladé perhaps mentioned, you know, trying to fund, you know, the full kind of life cycle of the project. So, you know, I know with mitigation in the renewable energy space, you know, you're looking at projects, you know, running over 50, or PPAs running over 15 or 20 years. So tenor extension was, you know, seen to be quite important, especially for commercial banks that can only fund up to 7 years because of, you know, Basel regulations, etc. So with the CFF, that's kind of the mechanism that at least we felt was appropriate in the South African context, or at least the Southern African context, since we're covering multiple countries. And to date, we have seen some traction in terms of interest, you know, in the facility. And we have a few projects currently that we are looking at where we have both mitigation as well as adaptation potential, specifically around water efficiency initiatives. We're also looking, apart from the climate finance facility, the DBSA are also looking at developing new programs in the water sector. Obviously, South Africa is, you know, it is a water scarce country. You know, City of Cape Town, they experienced a drought 2 years ago, and they developed kind of a water resource plan or water resilience plan to look at how can they diversify, you know, their water supply, which is currently focused on surface water, and climate resilient. You know, being climate resilient is quite key. So we've been looking at water reuse as one component to address that, not only for the City of Cape Town, but also nationally. So we approached the Green Climate Fund to acquire project preparation funding to develop a national program around water reuse. And the idea is to kind of effectively create a new asset class where, you know, commercial banks as well as other DFIs can, you know, support water reuse initiatives and support municipalities in South Africa, and hopefully with that model, you know, replicate that in the region as well. So we're hoping over the next 12 months, you know, we just started the project preparation phase, but the idea is to develop the right financial structure for a water reuse program in South Africa, and we hope, you know, early next year we will be able to, you know, have something that we can present to the GCF for implementation. We are looking at potential, you know, guarantee type of instruments as well. Of course, you know, not every municipality would have the same ability to repay loans, so we might need to have customized solutions for different municipalities, in this case in South Africa. So I think that's where we are in terms of supporting, you know, kind of adaptation-related projects, which is predominantly focused on the water sector. With regards to your second question, in terms of how we can support NDBs in the region and what are the barriers that they are facing. So, you know, as a national developmental financial institution with a regional mandate, the DBSA have certainly, you know, seen the importance of, you know, UNFCCC climate finance mechanism as key to set up these blended finance facilities. So I think it will be important to equip other national development banks in the region to also seek accreditation with the GCF, but it's not an easy process, as you may be aware. It takes a long time, and we have been trying to assist a number of entities in the region. We've done that with a commercial bank in Tanzania, for example, in recent years that have since been accredited. We helping, you know, the development banks in Zimbabwe and Namibia as well, and some of them are on the verge of accreditation. So that's one area where they need support, and we're trying to assist where we can based on our experience with accreditation. We also believe that accreditation may not be, it's not the be all and end all, you know, in terms of accessing climate finance. I believe NDBs can also play a strong role in terms of being executing entities rather than accredited entities. So working together with, you know, multilateral institutions or regional institutions that have already been accredited, where they can access the funds, and using NDBs as strong executing entities, obviously focusing on areas that are, you know, that they are, you know, that they have a speciality in, whether it's agriculture or what have you. So I think that's an approach which we believe, you know, would be much more practical, and that's kind of the kind of advice we've been giving to NDBs that are either seeking accreditation or are experiencing challenges with getting accreditation with the likes of the GCF, and exploring other ways of accessing climate finance by by perhaps looking at being executing entities for this project. So I think that's just some immediate suggestions, you know, that we offer for NDBs. Thank you all.
Great, thanks, Mohammed. And I've got some more questions for you that I'll come back to, but I want to come back to Ladé first, actually. And Mohammed there was talking about efforts that DBSA is already making to help kind of replicate some of the models and facility structures that they have found successful into kind of neighboring countries. And yeah, as you mentioned, you also mentioned yeah, this role of kind of replicating financial models and blended facilities that work. So I was hoping you could share some experiences and thoughts on how we can significantly scale up the use of such vehicles. Who are the key players and what needs to be done?
That's a great question, Will. And I don't think there's a single answer to that. I think there's a series of actors who need to be involved. But if I draw from some of the reflections that we published in our 2020 State of Blended Finance report, and this applies to adaptation, but I think more broadly to the SDGs and how you leverage blended finance. The first is that we do need the concessional capital providers to be more efficient and to prioritize portfolio approaches with simpler structures. We think that this piecemeal approach of just focusing on individual projects is really not gonna get us as quickly to raise the capital that we need to close the funding gap and really to implement some of these projects and activities more broadly. So having a portfolio approach, having simpler structures, being able to scale and to aggregate different interventions together, I think from our experience, is probably going to be a very important strategy going forward, as is considering business models. I mentioned earlier in my first intervention that we've seen a lot of activity in mitigation because it's quite clear how you commercialize that. So what are some other business models that can support adaptation activities and to really engage private investment? We also would like to see greater transparency, reporting around, you know, returns, and also the conditions that are associated with, you know, whether it's lending or other types of instruments that are utilized, and also impact reporting of transactions, not just at the ex ante level. This is, you know, before implementation, when you're designing the project, where you have a series of indicators that you're targeting, but actually, have you delivered on those impact metrics? We'd like to see greater reporting around that, because that'll then inform further project development and design, and you know, some of those important lessons can be incorporated into those structures as well. We also think that we need to standardize. Their innovation is great, but at some point you need to create things, as I mentioned earlier, that, you know, have been proven, can be replicated, where anybody can effectively take them and put them into practice. So it's very important for us to see some of these things. Right now, only around you know, I think half of projects actually report on some of these metrics, so that is well below what is required to really engage more private capital. And then I also think, you know, on a final note, we are starting to see some innovative structures and vehicles, as I mentioned. We've seen things where, you know, the Seychelles government was involved in this debt conversion transaction for marine conservation, but you know, we were only talking about $21.5 million. They issued the first blue bond, but again, you know, I think it was around 10 or 15 million. So these are still too small if you really want to attract private investment and if you're thinking about institutional capital. So this is also why portfolio approaches can be very beneficial, but you know, thinking about the broader ecosystem and ways in which you can aggregate, I think is going to be a very helpful means for attracting investment at scale.
Super, thank you very much, Ladé. And I know you need to send apologies and run off to next appointment in your calendar, but thanks so much for your insights, and I look forward to working with you and Convergence in Africa and other continents more in the future. So thank you very much. yeah, I wasn't quite sure whether to come to Charlene next on the case on the kind of potential sources of concessional grant finance for adaptation, but I'll first go to Tigere. So prior to joining the Dutch Fund for Climate and Development, Tigere worked for 7 years as an investment officer at IFC, the private sector arm of the World Bank, where he focused on manufacturing, agribusiness, health and education, and property in East Africa. And prior to that, he worked as a senior investment officer in the project finance department of a regional DFI PTA bank, now called the Trade and Development Bank, where he executed projects from Ethiopia to Zambia to Mauritius, Seychelles, among others, in Eastern and Southern Africa. So yeah, Tigere's got great experience developing deals in all the different business environments and investment climates of different ACP countries. Yeah, Tigere, so I want to ask you, what are some of the major barriers you see to investing in climate change adaptation in ACP countries? And maybe identify for us how DFCD has been designed to overcome these.
Okay. Good afternoon, wherever you are, and good morning to others. Good afternoon. I'm in Nairobi, in Kenya, and it's good afternoon. So the development, the Dutch Fund for Climate and Development is a consortium of 4 partners that is led by the FMO, the Dutch Development Finance Institution. The other members are Worldwide Fund for Nature, WWF, basically working on conservation and conservation financing activities. SNV, the Netherlands Development Organization. Then fourthly is Climate Fund Managers, which is a PE firm that pulls together financial resources for those that intend to invest in climate-related activities. The DFCD is divided into 2 pillars. Firstly, there's an origination portion, and then there's an investment implementation portion. The origination, which is led by SNV and the WWF, identifies and builds pipelines of projects that are climate adaptation inclined in terms of whether they're new or they're scaling up, they want to expand. We identify those who build the pipeline. We go to the grant funding investment committee. So there's a grant portion at the origination stage, which then tries to alleviate and de-risk some of the early stage challenges that businesses face. When a business graduates, which means they've implemented the origination activities, they then move on to investment implementation, which is financed either by FMO, if it is in agriculture, agribusiness, agroforestry, and energy for productive use. Or it is also financed by climate fund managers, if it is on the water, sanitation, and the health side. CFM, climate fund managers, would provide mostly equity, and FMO would provide mostly debt. We can discuss the details later on that. So those are the 2 stages: origination, graduation, then you go to investment implementation, where you get the necessary financing. Now, when we look at the challenges, to answer your question, Will, the challenges that businesses face in trying to access finance on climate business, I would put them into 3 elements. One is national or policy issues. The second is the supply side. The third is the demand side. And I think Richard in his presentation touched a bit on the national policy issues, where the policy is there on paper, but there's no implementation. And I would call that maybe the situation where the spirit is willing, but the flesh is weak. You have it on paper, you know what you want to do, but implementation is not happening. There are mostly weaknesses in mainstreaming the climate change business, climate change adaptation agenda into policy frameworks and national budgets. Hence, there's no implementation. You will find it's there on paper, but there is an office which is manned by very few people, some of which may not be experts in climate business, in climate change. Hence, no incentives are provided. The second aspect, which provides barriers to climate change adaptation financing, is the supply side. Generally, the climate business is considered to be unprofitable, unviable. But this is also partly because on the supply side, that is the financial institutions, those that provide the finance to support this activity, have a weak definition or do not have a proper definition at all of climate change as a business in their institution. So a corporate banking department is said to be financing climate change. But what specifically is there that they are putting in place to support climate change? You'll find in most cases in institutions that I've interacted with, most of them are actually doing solar home financing. They're financing solar home products, and I call that climate change business. So there is need for that specific definition and specific mandating of a department, having defined what climate change means to them to finance climate change. The fact that the climate business is considered unprofitable is also partly because of lack of market studies to prove otherwise. And a commercial bank is not going to go into studies just to come up and prove that climate change business is profitable, unless there is an underlying specific commitment that they've already made, hence they want to study this. So there is a need for institutions, possibly other than the commercial banks and other organizations, to do that study, do those studies, put them out there in the market, have them go through them and prove that, yeah, there is potential viability in the climate change business. I think Ladé and Muhammed also talked about financial instruments. And I, at the risk of repeating what they've said, I also want to say in my interaction with the markets that I've been in East and Southern Africa, they are unsuitable instruments. Most banks and financiers use traditional instruments. We won't go into the details of those, but I think Ladé is an expert on that. Traditional instruments are unsuitable for climate change business. Hence, there is a need to craft new products, new instruments that are suitable for the interventions that you want to make. And lastly, on that, on the supply side, lack of incentives. Most national jurisdictions have no incentive, or there are weak incentives to support climate change business. So the tax regime remains what it is. The regulatory regime with prudential lending guidelines from central bank remain what they are, despite the paper on national strategy on climate change saying we want to support it. There is no change in the tax regime, no incentive in the regulatory instruments. So those need to change. Lastly, the demand side. And I think most of these we are aware of them. While climate change has always been identified as a bank problem, financing climate change is a bank problem, and access to finance is a bank problem. We also want to recognize and say some of these challenges actually emanate from the markets in which we want to intervene. So in most of the markets, there is a lack of understanding of what constitutes climate change, whether the difference between climate change, mitigation, let alone adaptation. Very few would understand what that is. So there's need for awareness, define them clearly, make them aware, hold workshops for the beneficiaries that would be, so that they understand what is climate change, what is adaptation, what is mitigation. And hence when they are approached, or when they want to approach a financier for that kind of business, they know what they're talking about. Lack of financial literacy is paramount, in the sense that the businesses that we are targeting, most of these are small to medium scale enterprises, and they may not employ your chartered accountant and other financial experts. So you depend upon the finance manager, who may not be a financial instrument expert. You depend on the managing director, who may not know much about finance. So there is need to take into account the fact that the market, the demand side, needs to be educated. So institutions need to form programs that go into financial literacy training for the target markets that they have in mind. And lack of project conceptualization. Many a time I have received projects, even though we have outlined the criteria for the DFCD, that there is an origination portion, which you get a grant, you also contribute to the grant. Then when you graduate, you go to the investment implementation, where you get either a loan or equity. Many a time I've received applications that only talk about a grant. Someone is just applying for a grant. Can I have a grant to do a market study? And then you ask, what is your project concept that you want to implement after you've done market study? There's none. So we have stopped there, and we have to re-educate, go into the discussions. So that demand side education and on finance and conceptualization of projects is very important. And I would say those are the barriers that we face, and also the explained potential solutions that we can provide in that respect. I stop here. Thanks.
Thank you very much, Tigere. And yeah, I kind of wrote down many of these examples you gave, and I think you've kind of really kind of shown why we wanted to have this kind of series on private sector and investment climate reform and business environment reform, because many of these barriers are basic business environment reform issues, also building public-private dialogue you mentioned, raising awareness amongst the private sector around climate adaptation in the first place. So if any of the things Tigere mentioned are of interest to anyone interested to receive some support, then yes, send those emails off to the ICR facility and maybe we can support. You also mentioned Tigere tax regimes and kind of policy frameworks, and that's something that we are working on with Charlene, who's also on the panel as one of these papers as part of this series, which is a nice kind of segue now onto Charlene. Although change the topic for you. A couple of times mentioned earlier around the need for kind of sources of concessional finance, the concessional part of blended finance facilities. So we'll come on to that. Charlene's a associate at the ODI. Her work focuses on flows, sources and instruments of climate finance at both the national and international level. She's also part of the technical team on the UNFCCC Standing Committee on Finance's biennial assessment and overview of climate finance flows, an author of the Adaptation Gap Reports chapter on finance, something that's been mentioned in Richard's presentation and by others. And Charlene is also co-chair of the finance working group, the Independent Global Stocktake, which is an initiative that is working to support the UNFCCC's global stocktake process. So Charlene's kind of really on the pulse of sources of adaptation finance. And yeah, so as Richard mentioned in his presentation, Charlene, this adaptation finance gap, we've spoken together about the kind of complexity of you know, defining it and quantifying it. But what can you tell us about the landscape of adaptation finance globally? And can you tell us a bit more about what this gap is?
Thanks a lot, Will. And thanks very much to the ICR facility for the invitation to speak today. It's been incredibly insightful to listen to all the experiences kind of on the ground, structuring and trying to get adaptation finance to flow. But as Will has noted in the kind introduction, I've been working predominantly at the international level and considering the flows of climate finance. So maybe I can give you a little bit of an insight from where these concessional flows are coming from. So to generalize, maybe it's easy to think about adaptation finance coming from multilateral climate change funds through bilateral cooperation, and then from development finance institutions such as the MDBs, the multilateral development banks, as well as regional and national development banks. When we come to think about multilateral climate change funds, we can see that adaptation finance, or all climate finance in general, has been growing. And Dr. Sayed has already mentioned the Green Climate Fund, and a large part of the growing amount of finance from multilateral climate change funds is because of the Green Climate Fund. So it's the newest of the funds. It's been rapidly scaling up and approving projects. So its pledges stand around 20 billion, and it's so far approved about $7.5 billion since 2015 for climate change. And the idea of these funds is that they pool that contributor finance and they spend it around specific climate objectives. And they operate through multilateral, regional, and national organizations. The interesting thing is that they're one of the smallest of the sources of finance. So they're around $3 billion a year, $3 billion a year are coming out of the multilateral climate change funds. This is for both adaptation and for mitigation, but the finance is highly concessional. Got grants, concessional loans, more recently guarantees and equities. But the important thing is that in theory, these funds are supposed to be able to take more risk than any other kind of sources of finance. However, as Dr. Sayed's already pointed out, it's very challenging to access these, and there have been really high costs of becoming accredited entities to institutions such as the Green Climate Funds, but also the adaptation funds, for example. What we know at the moment is around 20% of the finance coming out of the multilateral climate change funds is being directed towards adaptation in the most recent time period. Now, this doesn't mean all of the rest is going to mitigation. There's about 48% to mitigation. Then you have about 5% going to reduced emissions from deforestation, degradation. And the amount of finance actually going to adaptation from these funds is a little bit obscured because we're seeing a big rise in cross-cutting finance. And that just means finance that's going to both mitigation and adaptation which is very representative of the situation on the grounds where, building resilience, adaptation, mitigation can be quite interlinked. So then if we go on to bilateral finance, it refers to that channeled through bilateral cooperation agencies. This can be transfers from what are known as developed to developing countries, or it can be kind of south-south flows, so developing to developing countries. That which may count towards the 100 billion goal, so from developed to developing countries, is around 30 billion a year. It's got a little bit more of a bias towards mitigation, around 65%, with 20% to adaptation, and again, around 21% to cross-cutting flows. And then there's the development finance institutions. So these provide concessional finance based on country contributions as well as retained earnings. And then less concessional finance is borrowed from capital markets with the backing of their shareholders. So we are seeing a rise in climate finance from these sources, particularly from the MDBs that made big commitments to scale up climate finance after the Paris Agreement in 2015. But despite these big commitments, there's been barriers to scaling up adaptation finance. So adaptation is around 25% of their climate finance, with a whopping kind of 75% going to mitigation. And I think it's already been mentioned by the panelists, the reasons for that. But unlike the multilateral climate change funds and the bilateral, the money coming from the development finance institutions, particularly the MDBs, are mostly concessional loan-based rather than grant-based. So I wanted to also emphasize that we know a lot less about domestic adaptation finance and private adaptation finance flows. So domestic adaptation finance flows have often been surveyed on a country by country or case study by case study basis. So it's very difficult to generalize because different methods are being used, different interpretations, as Tigere has said. But this is generally done through budget expenditure reviews. On the private finance side, we know much, much less than we know about international concessional adaptation finance. So why do we know less? Firstly, a lot of information is very sensitive. Deal data just isn't available. But secondly, it's not always called adaptation, which has become challenging. So it could be called business continuity, emergency preparedness, environmental vulnerability assessment. It might be part of insurance, forecasting, or risk management. It's also very hard to get at autonomous adaptation or soft adaptation, like building capacities. So where there is data, it might be focused on hard adaptation, so building a flood defense or a seawall. So our understanding of private adaptation is just very difficult to get a handle on the data or even get access to data. And that's in direct contrast to databases that exist, for example, Bloomberg New Energy Finance on renewable energy, or IEA databases on transport and clean transport options. And of course, mitigation also has that benefit of having this measurable metric, a clearer list of economic activities that might count, whereas adaptation is very context specific and location specific, and vulnerability has many multi-causal factors. So we're talking about financial access and aspects of education and health as well. All in all, it's worth saying that the landscape of adaptation finance is improving and scales of adaptation finance are growing. But it's worth reflecting that if we only consider the numbers, we're not saying anything about how effective that finance is. And also just counting the amount of adaptation finance doesn't tell us anything about the finance that could be increasing vulnerability to climate change or could be maladaptive. And then just kind of this brings me to talking about the gap. So we know that adaptation is underfunded. And Richard mentioned in the presentation that of the flows that we can track, we're seeing about 30 billion a year going towards adaptation in the 2017-18 period, as estimated by the Climate Policy Initiative. So in contrast, the needs are much, much higher. So 140 to 300 billion a year by 2030, and then rising as we get to 2050, as presented in the Adaptation Gap Report. So as I've already said, part of that gap is a data void. We just don't know what households are investing in hurricane shutters, boarding. What are the additional costs as people change their seed types or irrigation systems, or the cost of supply chain contingency planning in corporations because labor's been disrupted because of heat waves or physical disruptions because of flooding. And then the other part of that gap, which I think really needs to be understood to have a true discussion about that gap and how we fill it, is where should that money be coming from? And I think all of the panelists have touched on this, and Richard touched on it in his presentation as well. So countries need to elaborate their adaptation plans to understand the costs and therefore the needs for financing. But to elaborate a little on this, it's very important to say that countries have been asked to provide adaptation plans in many, many formats. People will remember NAPAs, and then we've also got NDCs, we've got national adaptation plans. And to an extent, there's information in national communications and biennial update reports. And these are all reporting processes under the UNFCCC. But few of these plans, as Richard has mentioned, go into detail about where the money is coming from. And that needs the deeper understanding, as Tigere has referred to, about what is needed for adaptation, what are the costs, and then also what are the flows of finance, the gaps and the barriers, incentives that are driving these flows. So, if you have that true understanding, you can understand, do I need debt or do I need equity? What is my market structure? Is it mostly bank lending, which has the shorter time horizon, or can I look at a larger time horizon and get access to capital markets? So we've already discussed that a lot of the barriers around capital market access, untested technologies, can be broken down with international concessional support. But we need to see shifts in incentive structures as well, again, already mentioned by the wonderful panel, to make sure this concessional support turns into something that's much more sustainable over time. And I just wanted to emphasize that it is necessary to incentivize adaptation measures in agriculture, and this might be making public support for agriculture conditional on certain farming practices to make it more adaptation relevant. It might be necessary to shift water pricing and tariffs to increase their efficient usage. So a combination of, also maybe a combination of the domestic and the concessional finance could be needed to establish regional risk pooling schemes, providing liquidity in the event of a disaster. So clearly these financing strategies are going to look very different between countries with diverse needs and market context. But the point is the gap framing on its own isn't useful. Until we know more about what kind of finance we need, how it can be, where it needs to come from, and what type and what kind of structures we can use. That will be then when the adaptation gap can really be filled. Thank you.
Great, thanks, Charlene. Lots of stuff there, and I think we'll cover some of it in the kind of next questions, and also together in the report we're writing, drafting at the moment. I want to come back to a point I think Charlene, Tigere, and Ladé all made around having effective and efficient facilities and mechanisms for investments. So as kind of Charlene referred a little bit to about kind of availability of international concessional finance, the MDBs and the regional or national development banks play an important role in kind of transferring those funds from the international level down to the domestic context where they have impact on the ground. The EU itself is in the process of designing its new external investment plan, and I can see in the attendees today some people involved in kind of some background work and design and strategy work around that process. So I guess to you, Muhammed, if you had any suggestions on how they could better design that facility, or broader thoughts on the design of better design of facilities to ensure that finance flows to critical adaptation projects.
No, thanks, Will. I think it was highlighted earlier that a big barrier is the lack of, or one of the, the issue that we often see when it comes to climate adaptation is the lack of bankable projects, and also the need for project preparation support. And we've seen this in the South African context. We've actually set up a dedicated project preparation fund, specifically, to take projects to bankability, and that will be fed into the various programs, that, for example, the DBSA is looking at, and also, feed into some of the climate finance initiatives as well. So, from our perspective, I think, trying to support project developers, developing bankable projects in climate adaptation would be quite key. So I think if this facility has at least a component that talks to that, I believe, that would be extremely useful, especially in the environment that, in Southern Africa, where a lot of the projects that we've set up or put up calls for RFPs, and the quality of the proposals that we receive, that people respond to, unfortunately, there's a need for project preparation. So to me, that's quite key. A second issue is around capacity development for NDBs. I think one thing I just wanted to highlight is, getting accredited is one part of the journey, and that's the first hurdle. But post-accreditation, developing proposals and taking proposals, whether it's a GCF or other entities, that requires dedicated kind of units within the NDBs, dedicated climate, specialists, that are able to evaluate, projects in that sector. So I believe that there is a need to support NDBs, especially in the region that we've, geographical region that we focus on. A lot of NDBs are in need of that capacity and technical support in terms of being able to develop these climate-related projects. So I think, focus on capacity development would also be key. I also wanted to just make one point that, from our perspective, we've been looking at a programmatic approach when it comes to climate finance. I think Ladé might have mentioned it earlier that it's very difficult to do it on a project-by-project basis, especially if you're trying to access funds from the GCF. It's a very long process. It can take anywhere from 6 months if you're lucky, but sometimes up to 2 years, to take a project from concept, to board approval. So our approach as DBSA has always been to develop programs or facilities rather than individual projects. And I think what we're trying to do now is to develop facilities that can be replicated across the region, where other NDBs can also have their own climate finance facilities focusing on their specific areas of interest. So I think any facility that can maybe scale up these type of models and allow NDBs in other countries to perhaps replicate some of these programs that have been proven successful, I believe would be quite quite important. So yeah, I think those are kind of my immediate suggestions that come to mind.
Great, thanks, Muhammed. Tigere, I want to come back to you and links to Muhammed's points around bankability and also having kind of successful models that can scale, and DFCD itself is a facility in this language. I want to ask you, Tigere, about some of the key kind of challenges around kind of finding investments, and share some examples of businesses, of investments, yeah, some examples of potential investment deals, and explain what's been the key success factors when it comes to sourcing them and finding this pipeline.
Sorry, I was muted. So thanks, Will. So the DFCD is relatively young, but we are happy so far with the success we have scored in Sub-Saharan Africa. And remember, we are also in Southeast Asia and in Latin America, but here specifically talking about Sub-Saharan Africa. We have been fairly successful in agriculture, where we have managed to facilitate access to finance for smallholder farmers, largely because smallholder farmers face challenges at the beginning of the season, cash flow challenges. They don't have money, but they still need to acquire resources and to acquire inputs into their farming activities. We have also been successful in water, sanitation, and health in East Africa, where we have supported a project in arid and semi-arid regions for businesses and communities to access water at a relatively competitive cost compared to what they are currently accessing. And we've also facilitated, currently facilitating the establishment of a cold chain for agricultural perishables, talking about vegetables and fruits in horticulture that go into export. How has this come about? And Devin talked about the challenges that the demand side faces, that is the clients we're targeting. How did this come about? It is our feeling as the DFCD that we came up with a well-defined mandate on climate change adaptation. We're not focusing so much on mitigation, but more on adaptation, where we are saying we want to facilitate systems change in the way businesses operate, so that they are geared for this changing climate. Because in some situations it has already happened and they need to adapt. In some situations it's inevitable. Climate change is happening and it's going to hit certain areas hard. So how do you help them to change the way they do business so that they can become more resilient. So with adaptation, we're trying to build one, systems change, resilience in their activities that they are carrying out, and also sustainability, which means we need to win them off from donor money so that they become self-sufficient in supporting their own businesses. That's the only way you can then establish sustainability. Otherwise, if they continue to remain dependent on donor funding, we see what has happened with COVID, where funds are diverted from other activities supporting COVID. So if you're donor dependent on your business activities, then that affects you when such things happen. So it's a well-defined mandate by the DFCD, and we're using what we call the landscape approach, where we, in each country that we intervene, we identify the climate vulnerable areas. And we say, in these areas, what is it that is impacting on the businesses? And then on our side, what is it that we can do with these businesses to help them change systems, become more resilient, adapt to changing situations? So in sub-Saharan Africa, the key ones that we've identified, for instance, in Zambia, the Kafue floods is a climate change vulnerable area. Yet it is a very important area region also to Zambia, especially the southern part, because of water resources. But these water resources are being either used inefficiently or they are being allocated in a way that will certainly affect operations in the near future. So how do we work with companies in that region to change the way they use water, use it more efficiently, and also manage the resources going forward? In Kenya, we do also have a landscape that is clearly identified, which touches on the part of Tanzania and the border with Kenya, which we call southern Kenya, northern Tanzania, or SOCNOT. These are arid and semi-arid areas, but also there's a lot of agriculture happening. So how do you adapt? How do you help these adapt to climate change? Again, our landscape approach, we think, has been well defined and is targeting those that we want to target. So you identify a landscape, you describe the socioeconomics of the area in which you want to operate. You look at the environmental dynamics around the anchor investments that you want to work with. And then you highlight what sectors, what industries do you want to impact on, and what are the drivers for that business. Stakeholder engagement is key. You need to go out there, talk to the communities, talk to the businesses, and see how they buy the idea of climate change adaptation and what they need to change in terms of systems and how they can build resilience. I'll give a very small example. In one country in Eastern Africa, where power is considered key for their survival, a certain foreign company came in and wanted to implement a wind power project, which would generate power from wind and supply the locals as well as businesses. After having done their project planning and everything and wanted to implement, there was so much resistance to this power project, emanating from media issues, political issues. So they had to abandon the power project. It's a well-known project in one of the countries in East Africa, which I will not mention. So without community engagement, you are vulnerable to all sorts of interpretations by the communities which you want to impact on. So DFCD does that. In our activities, apart from providing grants to the companies we want to work with, we also provide technical assistance, where we work with SNV experts in various areas to go to these areas, engage the communities, get their buy-in, and then understand that this is what you want to do. For instance, the water project I was telling you about, it is a project that draws water from boreholes or brackish sources of water, purifies the water using solar power only, no fossil fuels. Then it stores the water in some other tank where it is purified, and it dispenses water to the communities via M-Pesa, those that know M-Pesa, or mobile money transfers, where you get a token, you go to the machine, to the water dispenser or the water kiosk, you punch in your code, you put your container down, water comes in. This is clean, potable water, which meets WHO standards. So in that respect, the community was then, before that came on board, was taken through what this investment entails. It's not charity. Otherwise, they would misconstrue it that they are not supposed to pay. You take them that what you're currently consuming is dirty water, but you're paying this price for it. You can have this same water, purified, cleaner, healthy, at this much lower price. And this is how you benefit. And you can save your women and girls long distances finding water. So they bought into that, and the project is going into implementation. And also ensure that you address a specific need We have organizations from all over the world coming into Africa, throwing money at problems. And then you realize at the end of the day, when you do monitoring and evaluation, there's nothing much to talk about in terms of impact. So you need to define and identify a specific need that you want to address. And then you, after, of course, that's after doing your community engagement. When you identify that specific need, you then need to come up with a proper design of how this is going to work, and then also proper implementation, your intervention, have the necessary financial products, as well as the non-financial products like the TA from SNV. So this is what the DFCD has done, and this we think is part of what we can today record as the success we have scored in this region. I don't know if that answers fully your question. Thank you.
Yeah, thanks, Tigere. Again, tons of insights there, and I'm very lucky to be working with you directly on this and learning a lot. I think a couple of things that really have stood out to me from both your inputs are around these, I guess, the role of the government in leading stakeholder engagement and building this awareness and capacity, but also kind of supply, and then from yourself and from other contributors, I think quite a kind of clear like additionality, I think would be the kind of donor or kind of technical term, clear additionality for these like project preparation type facilities that can, especially in climate adaptation, where we really are trying to promote investment and accelerate the action on the ground. Quite a clear need of how, quite a clear story of how these like project preparation facilities, including everything from partnership building, dialogue, stakeholder engagement, through to capacity building of those businesses, as well as some more technical assessments, can really kind of contribute to getting some of these projects into a bankable state where they can be picked up by facilities and kind of turned into investments that can have finance channeled to them. I want to kind of start to wrap this up by coming to Charlene. Charlene, we're both Brits, or mostly British. COP26 is going to be happening this year in Glasgow. I have two Scottish grandparents as well. That's a good one for Scotland. And climate finance, as always, but especially in these kind of really kind of high priority, important COPs, climate finance will be a really substantive topic. So yeah, interested to ask from you how the issue of adaptation finance in particular is being examined. And yeah, maybe what more can be done by all of us here today to deliver high quality climate finance, ensure it's going to the right projects, and build an argument for more concessional finance to come at a large enough scale into facilities that can then effectively and efficiently get it on the ground and leverage private and commercial investment at the same time.
Thanks, Will. That's a big question. Yeah, so I'll talk a little bit about COP, but maybe I want all of us to think how, I don't want us to think from one COP to the next. This has to be a longer term strategy and a longer term plan for raising adaptation finance. But in the context of COP26, it was supposed to be held in 2020, and that is the target year, or was the target year, for the 100 billion goal for developed countries to mobilize from public and private sources annually for adaptation and mitigation in developing countries. So because it was the goal year, it was also the end date for many climate finance contributors' targets and strategies. It's also a moment where we kind of switch gears into the post-2020 climate finance architecture, and that's really important that we actually use that moment and take that moment of reflection. Where have we come in the last 10 to 15 years? And also acknowledge any mistakes. Well, that didn't work, or we shouldn't have done it that way. This would have been a better way to do it. I think it's really important to use that as an opportunity. So this COP is also the COP where we start negotiations on a new and a bigger goal for climate finance from the baseline of the 100 billion to be agreed by 2025, as was embedded in the Paris Agreement. So these conversations are likely to be truly heated. Climate finance conversations and negotiations often are. There's long been challenges for developing countries to seek clarity on the adequacy and the predictability of climate finance flows. And some contributors have set targets, so the UK's commitment to spend £11.6 billion pounds over the next 5 years. But it's not always clear, either from the UK or other contributors, exactly where that money is going. So, you know, £1 billion of that amount is actually supporting UK institutions to do research on low emissions technologies, for example. And then just a final piece of context, there's no denying that 2020 was a tough year. And we need to account for that extra pressure all over the world on public resources. So then we have this twofold challenge of finding the climate finance can continue to scale up adaptation finance amongst other priorities, but also in articulating that importance and capitalizing on this importance of climate change in recovery measures. So this so-called kind of green recovery. So in terms of how adaptation finance will be examined, we can expect, as I've said, to see this resurgence in a number of tricky topics. So one of which is the balance between adaptation and mitigation in that 100 billion goal. So while we asked for balance between these two themes in that 100 billion goal, it was never defined what balance meant. So we don't know if that should be 50-50 based on the face value. So that means not taking into account if it's a grant, it doesn't have to be paid back, or a loan or a guarantee. So whether or not we need to look at that in grant equivalent terms or not. And of course, that changes massively the numbers, given more mitigation finance is given as debt finance, loans, for example. The other part would be that the language in the Paris Agreement prioritizes least developed countries and small island developing states, but there's no benchmark of how much is enough. Should they get 25%? Should they get 50%, for example? And this kind of reflects a broader debate about vulnerability that's never been well defined in the negotiations, which are the most vulnerable countries. How are we measuring that? And also how to take into account the allocation of climate finance. You know, for example, there are countries with very high physical risks of climate change, but they're also just about to graduate to high income status. You know, for example, a number of small island developing states. So with these some of these tricky topics in mind, hopefully there will be discussions about having sub-goals for climate finance, for adaptation explicitly, as well as some hard discussions about respective capabilities of countries and how we can prioritize and allocate efficiently these resources. And then, you know, also on this point, the COVID pandemic has stimulated new discussions. Maybe we would call them non-traditional discussions in adaptation finance. So more discussions around debt for climate swaps, the role of special drawing rights in the climate response, and maybe more importantly, the debt-heavy nature of a lot of climate finance may need to change. So definitely we can expect these new issues to be coming up. And then in terms of what more can we do, for me, there are maybe 3 things that can be done by way of practically moving forward to more, you called it effective adaptation finance. And the first one is, again, you know, this panel is fantastic. They've mentioned everything I wanted to. So the first one is understanding the impact of adaptation finance. So I understand it's a challenge, it's very context specific, and it's very hard to get the right metrics, but we do need to learn more from our past spending. What worked, what didn't, why, what are the nuances of the situations and the barriers to private investment? When did they get reduced most efficiently, or what finance was truly transformational? And some of that is happening within institutions, but we don't really have any kind of global level accountability or learning systems for really getting these details that could really support more effective adaptation finance moving forward. The second one was getting finance to national, regional implementing entities and capacitating more entities to program adaptation finance. So there remains to be a role for example, for multilateral development banks and other international implementing entities, but we need to continue to try and get climate finance to local level. Dr. Syed already mentioned in one of his first interventions, you know, the peer-to-peer learning, the potential for on-lending. But we can also think about how, you know, how can we better get access to micro, small, medium enterprises, to small-scale farmers that might be part of the informal economy, to local NGOs and even subnational authorities, because, you know, at a national level, there's many different structures that exist in countries. And these actors are more likely to have a very strong awareness of the local context, what is needed for adaptation, and may well require finance that takes more risks, but equally they could have the potential to be more effective and transformational. And then the third one is just really linking up What we see is the private sector's growing understanding of the materiality of climate risk and how it will affect their bottom line with climate policy. So we speak different languages. We talk about different sectors. Climate sectors are not real economy sectors. The policymakers don't always understand the role private sector can play in the multitude of private sector actors, and private sector doesn't always understand the role they need to play in adaptation, which doesn't have a clear list of economic activities necessarily, or their impacts on climate change. So this could be dialogues with private sector actors, working groups, training, and these have all been mentioned before. There are many things that can be done to capitalize on this drive to understand, disclose, and internalize climate risk, taxonomies, guidelines, changing capital liquidity requirements in central banks, disclosures, so on. I mean, I could go on, but I think that's a really neat way to kind of try and capitalize on this growing momentum to increase adaptation funding. Thanks.
Great, thanks so much, Charlene. And yeah, very on message. I think your last two to-dos are kind of highly related to the ICR facility around working with kind of regional and national development banks, and the third one around which included kind of policy dialogue and building that engagement between government and the private sector, and really kind of opening two-way communications between them. And those are two things that the ICR facility has been set up to do around SDGs in general, as we heard during the introduction. And if climate adaptation is one of the things you're working towards, the ICR facility can definitely support that. So that is it from us. There's a couple of questions. I guess the one on practicalities. Papers have been sent to you through the chat dialogue, the PowerPoint. And there's a couple of papers, like short reports on this topic, already available. So yeah, check. I think they'll be emailed as well automatically. Okay. I'm going to read a couple of questions here. So panelists, if you can kind of listen in. So firstly, what is I think this is what is your proposition to integrate? Oh, sorry, it's flicking around in my dialog box. Sorry, I started reading a question and it disappeared. Okay, I can't get this dialog box to behave, but there was a question around social enterprises and the link with social enterprises. Here we are. What is what's our proposition for integrating the issue of climate change with social enterprises? The major goal of social enterprises is to undertake business further addressing social and environmental issues. So if we integrate climate issues with social enterprises, I hope it could be a panacea to mobilize funds and stimulate innovation. So that's one question around social enterprises. Perhaps maybe there's someone from the British Council on the call. Our partners in the ICR facility, the British Council, have been working on social enterprises very closely. Here's a question in regard to stakeholder and engagement and goodwill in the implementation of climate change projects and programs. Is there space or allocation for innovative youth engagement on advocacy? I think this would play a significant role in project conceptualization and success. So those are both at the kind of micro end of the scale, and then on the big end of the scale, we have a question. Could you provide any suggestions on how the EU could tailor the EFSD Plus to leverage more private sector adaptation finance? So, do I have any volunteers from the panel to tackle either of these questions? Social enterprises, youth engagement, or structure of the EFSD plus?
I'm happy to jump in. I don't think I could answer any of these questions fully. I don't think anything is a panacea, and I think the scale of the climate emergency means that we have to take any routes possible. So that means I do think we should look at social enterprises, how they can support. I don't have the answer for you as to how they can support, and I haven't been specifically working on that. But I do think we need to kind of put all hands on deck for this. And then with respect to youth, I think absolutely I had a really interesting conversation with the Coalition of Youth for Climate Change in the UK and worldwide about climate finance. And there absolutely is space to engage, and a large part of that is making sure we hold people to account. And that might be governments to account for their provision, it might be funds to account for looking at their impacts, or it might be governments to being held account to make sure we don't spend money that is misaligned with our climate change objectives that we've signed up to. So I really think, you know, it's all hands on deck and finding any solutions we can, but I do think we have to be very careful about the narratives and the way that data around climate finance is being used and misused. So that's the only caveat, is to make sure you know your data and use that for evidence-based decision making. Thank you.
Sorry, well, maybe if I could just add something. So within DBSA, we supported kind of young entrepreneurs. We had a green incubator which we supported through a national green fund a couple of years ago. It's a very small fund, and the idea was to try and support you know, youth in South Africa, the South African program. You know, they had innovative ideas around not necessarily just on addressing climate change, but also, you know, just the supporting the green economy as a whole. And there was a need, you know, to try and support innovative business ideas, and we looked at, you know, financing a climate innovation, you know, center where we supported, you know, new business ideas, taking it through the various stages of commercialization. And we also had another incubator focusing mostly on social enterprises. So these were kind of more grant-based kind of support mechanisms to kind of encourage youth to enter the space. So I just thought, you know, that's something we have done. I believe, you know, the one incubator, you know, they've reached a point where they managed to kind of expand, you know, their reach beyond, you know, what we provided. So I think at least, you know, that was, I believe, a success. So I think that's one intervention, you know, which may be able to kind of encourage and involve more youth to get into the space through incubators.
Yeah, well, I think I can add to that and link up with what Muhammed and Charlene have said, which I think is quite critical. I will just be addressing questions 1 and 2. I don't know much about the EU fund. So for the social enterprise and how we can integrate them into the climate change and the financing aspect, I also feel integrating them is not a panacea for the challenges that we are facing, but it's worthwhile doing so, because them alone will not solve the need to raise funding for climate change financing. But even on the private sector side alone also, because of the profit motive and other overriding initiatives, may not be the solution. So the idea then is not to have a Lone Star Ranger approach, but to collaborate, the two parties, those that have cheaper funding or non-commercial financing, come together with those that have their commercial funding. The other side of the commercial side, they've got the clients, they've done their sector mapping, they've got a pipeline. The other side, which is non-commercial funding, have got that funding, that money which they have, which they need to use to the benefit of their targets. So bringing these together would lead then to the blending of your finance. What instruments you come up with, I think, is critical to make sure that it targets what you want to achieve. The other element which touches then on the youth is that, with experience of what I've seen in East Africa, funds targeted either at women or youth end up being politicized, where then politicians want to lead that initiative. But my recommendation would be such a fund should be, one, non-political, should not be channeled through a government entity, should be standalone, and then target those youths that you want to benefit from that fund. Interacting with the youth, they have very innovative ideas, but what they may lack is the business side. So what you need them to do is to build an element into that financing, the financial literacy, but also the business side of doing things. They come up with their innovations, teach them how you can translate that into business. In my previous life, before joining DFCD, an organization I used to work for had a product called the Business Edge, as in EDGE Edge, as the edge of the cutting edge, right? They would come up with such a program, target certain youths that want to invest in a certain project, but before they give them a cent, they would then say, we want to understand where you are in terms of your level of understanding of the business. What do you know about marketing, about accounting, about administration, about value chain development? And based on the responses, they'll then program or structure programs that would take youths through training for management, whether it's market, whether it's administration, whether it's accounting and value chain development and all those things. Only after they've graduated from there can they begin to access the funding that is available. So several funds like in East Africa and the countries that I know, they've come up and they just give money to the youths. When you try to find out what they use the money for, it has really gone down the drain and hasn't achieved the purpose for which it was set up. Thank you.
Thanks, Tigere. Certainly that speaks to the learning lessons from kind of prior approaches. Actually, I know on the topic of youth, the ICR facility has been supporting the government of Ghana on a green jobs program, I believe, through the ICR facilities technical assistance program. And also in the chat dialogue, some links to the work around climate change and social enterprises have also been posted. So there's a kind of webinar that was held, I think, just in early December on this topic by the ICR facility, as well as a kind of a link to the website where there's going to be a forthcoming report on that. Unless anyone wants to reply specifically on the EU's new fund, Divya, maybe we can kind of sleep on that one a little bit more and come back to you on some ideas for the EFSD Plus in the future, unless any of the panelists got any specific recommendations on that.
I think I think as I mentioned before, in terms of the focus of the EU's new Sustainable Development Fund, I think they need to identify obviously what's currently out there. There's obviously a lot of EU funding that has already gone into various initiatives, and where is the key gap? I've already mentioned the issue around project preparation, which is quite important. The second issue is around the capacity development, as I mentioned before. So I'm not too sure to what extent, and that's not obviously investment funds, but it's more looking at how do we capacitate potential executing entities such as NDBs to implement climate adaptation projects. So without that support, technical support, to couple the investment funds, I believe a lot of the funds would be stuck. You won't see a lot of traction. So to me, we need to find a way of addressing that particular barrier to implement projects, which a lot of NDBs, at least in the context, the geographical context where we work, where we work in, these NDBs are facing a lot of challenges in that regard. So if this particular fund can have some sort of element that addresses that, I believe you'll be able to see more traction and movement of the funds. It wouldn't just be sitting there, but you will see actual implementation as well.
Super, thanks very much. So I think on that, I'd like to draw the morning, afternoon, evenings online event to a close. Thanks to everyone who joined. Thanks especially to everyone who participated and prepared and gave expertise and insights. Rich and I really appreciate your time and your contributions. just a kind of reminder again for eligible participants, so that's kind of ACP country governments as well as partners, institutions, working with and supporting them. The ICR facility offers kind of one-on-one clinics or sessions with experts to further support you on the topics discovered today. Maybe kind of helping you narrow down a few questions, and then can also offer more structured support through technical assistance facility on some business environment reform, public-private dialogue issues. So you can see on your screen and in your emails and on the PowerPoint attached in this webinar some kind of information on how exactly you can go about doing that. Yeah, thanks so much. Before you go, a poll is going to be on your screen, so if you could help us a lot by just spending a couple of seconds to answer these questions. And otherwise, yes, I wish you enjoyable rest of your day or evening, and thanks so much, and we look forward to engaging with you more through email or LinkedIn or our various reports and future webinars. Thank you very much.